All right. So here is the ratios of, again, Home Depot and Lowe's in regard to their total asset turnover, and operating profit margin, and operating return on asset. So, and some other turnovers. Again, comparing these two companies, you see that as far as the operating return on asset, they're very similar to each other. Same with operating profit margin. Same on the total asset turnover, very close to each other. But look at the account receivable turnover. 291 versus 27.34. So meaning that Home Depot turnovers the account receivable, meaning they collect only 27 times a year, while Lowe's 291 days a year, or times a year. So if you divide 365 with 291 is what? Maybe every day and a half or something like that, they're collecting their money on average. Versus if you divide 365 by 27, you're going to see a big difference there. So meaning that Lowe's collect their money from their customers much faster than Home Depot.
Is that an entirely telling number though? Because I mean, if you base it on the size of the receivables, could it be skewed, I guess, in a way?
Yeah, like I said, this is only a clue,
Yeah.
and you're going to do an investigation as to why.
Right.
I'm going to find the differences. Oh yeah, well they're doing this, the other company is not doing that.
One could be incentivizing monetarily to pay.
Could be that, could be they're offering incentive for their customer to pay it early.
Right.
Right,
Whatever.
many of those different policies.
It's
Or-
just kind of it's just a guide, is what you're saying.
Right.
Okay.
So maybe it is that, hey, we give you a discount if you pay cash. So they're collecting mostly cash, nobody's owing them any money.
Right.
So it could be any of those
Okay.
reasons.
Right. Thank you.
Sure. Inventory turnover, it's very similar, not much difference. Your fixed asset turnover, the same. So everything is the same except for Lowe is extremely active in collecting their money from their customers. That's all. And in many terms, like we don't have the profitability indexes and other things here to tell us. We know, I think Home Depot is more profitable than Lowe. We know that.
Right.
But that should be due to some other factors rather than collecting their money faster than Home Depot.
It was interesting because I was in that industry for 12 years, and that it gets back to, like you said, their business model. One is more consumer oriented and one is more contractor oriented.
Exactly.
And the payables of those two are different.
Absolutely.
So
That's probably the answer, is that when Home Depot deals with a bunch of subcontractors, the different type of companies, they're not paying cash. And some of them actually, they deliberately delay paying it, even they're willing to pay the penalty.
right.
Whereas, let's say in Lowe's, they're dealing with individuals and giving incentive, hey, you pay cash, you're gonna get 5% discount or whatever. So that's probably why, and again, these are all assumptions. Okay, let's move on. I talked about all these. Okay, well, net income, return on equity, okay. Net income over common equity, we talked about that, but I'm gonna also, you see that these are all, I put it on the board for you to elaborate it even better. However, going to example of this company Boswell as an example here, you see that their return on equity is 22.5, which is above average in the market. However, their net profit is lower than market. Total asset turnover is also slightly higher, it's okay. Why they have low profitability, yet in the meantime, the return on their stocks is higher than average market? What would be possible reason for that? I think part of the answer could be equity multiplier. What is equity multiplier? I put it on the board there. Financial leverage. They have higher financial leverage than average of the market. Higher financial leverage always translates to higher rate of return on your stocks or equity. Why? Because high level of debt creates high level of return. Why? Because again, the same trade-off, high risk, high return. They have higher level of debt in the market, therefore the stocks is yielding a little bit better than market. Okay, here it is, what I put on the board for you earlier, Dupont Model. And as we discussed it, that some of these data come from your income statement, some come from your balance sheet. The reddish area is, or pinkish area is your income statement. The green is your financial balance sheet. And you see that how which of these items are entered in our calculation. And finally, we got that three element of profitability and efficiency and financial leverage, and all equates to return on equity for this company is 22.5. You also could assume it yourself, folks. Stocks up with this company pays 22.5 rate of return. That's high. So why is high? Because they're more risky, that's why. And how do we know that? We're going to spend a week on it in the class. I'm going to show you how the investors recalculate their expected rate of return based on the what? Recapitalization of the companies. What is the recapitalization? When company decide to increase the level of debt and then purchase back its own stocks, repurchasing its own stocks and replacing it by debt. That was a lost airplane. Nobody, they shouldn't fly here. So, when companies replace their equity, their stocks, repurchasing their own stock by borrowing money, that's called recapitalization. When they do that, they bring the level of what? Debt and debt ratio higher, right? You have more debt now. You as an investor, you should not be satisfied with the same rate of return. Wait a second. I was happy with the 12% rate of return of your company's stock because you had only 20% debt. You were not as risky. Now you have 60% of level of debt. You're extremely risky. I'm not going to settle for 12%. You see what I'm getting at? Then you're going to demand higher rate of return because of the riskiness of the company. Now, what percentage you should be demanding? There's a formula for it. You're going to learn that formula. Mean that you're going to, this is called the Manda equation. You're going to use this model or formula to determine the beta of this company. What is beta? Beta is risk coefficient. Okay? And we're going to talk about betas also. I'm going to show you all these in the future. So another word, what I'm saying is that you're going to come up with the risk factor of this company and recalculate it. And then when you get it to be higher, then you're going to enter that to your calculation of your stocks rate of return. I'm going to also teach you how to do that. I'm going to say, 12% is not going to cut it. Either 14.5% or I'm going to dump your stocks. Guess what? Companies do not wait for that stuff. They already just use. They say, hey, don't worry, we already took care of it. So your expected rate of return on your stock is 14.5%, it's not 12 no more. They know that. But that's what you do. So my point of saying is that is that high risk, high return plays an extremely important role in the market. Meaning that your higher rate of return of any stock that you're receiving is not because they are this magnificent company is so, no. It's because of high risk. That's it. Some companies choose to be that, it's okay. But you gotta know it is or it's not. For instance, one of the downfalls of my company was that we merged with a company that was highly financially, they had high financial leverage, and they were highly what we called credit-based company. And our company was asset-based company. So asset-based company means that if the thing that you own as your asset, you own it. You own it through what? Equity. Meaning that you have stockholders, you have all your asset, you don't need any debt. Actually, my guy, the founder of the company, I don't know, 90 some odd years ago, he said that this is my business model. I don't want to have any debt at all. I want to be a solid company forever. Yeah, we were enjoying rate of return of our stock, half of our competition. But we were solid. So what happens was, things turned around. Many things changed. Like what? Our industry started declining. When that happened, we couldn't survive the market by ourselves. We had to join a hand with what? Our competition. We were number one, they were number two in the market. So we want to join each other. Actually, it was a merger to sustain ourselves in the market. When that happened, now we understood what is the benefit of what financial leverage. We went to any place to borrow $2 billion to buy the other company. Nobody gave us a dime. And we were a multi-billion-dollar company. Why they didn't give us money? Oh, roadway. Have you had any debt with me or any borrowed money? No. Have you had any borrowed money with any other company, any other financial institution? No. You have no credit history? No. How in the world I'm going to trust you to give you money? They didn't give us money, basically. On the other hand, the other company, Yellow Transportation, they had, I don't know, I mean, at the time they were telling that 75% of their assets were purchased by debt, but later on they said, no, it's higher than that. What they announced was 75%. Anyways, highly leveraged company, highly risky company, and their rate of return on their stock was twice as much as ours. So they had to borrow money, and they borrowed money from Bank of America, $2 billion. Of course, in terms of billions, normally one bank does not loan out. They go jointly with other banks to reduce the risk. So they joined with the Deutsche Bank of Germany, and they got $2 billion and they bought us. Basically, we were under impression we were going to be merging, but actually it happened that they ended up acquiring us. We were the target company. Why? They had the cash, we didn't. And we were number one, by the way, they were number two. Yeah, we were, meaning that revenue was, we were higher than Yellow, market share more than Yellow, number of the terminals more than Yellow, and everything. We had 34,000 tractor trailers, 36,000 employees, and 600 terminals. Some of those terminals were 3 times as big as a football field. So we're talking about major facilities.
And you were publicly traded?
Mm-hmm. Mm-hmm. And it still is. But today it's called Roadway Yellow Corporation, RYC. I'm sorry, Yellow Roadway, because I'm not part of it anymore. When they merged, I exited the company. Roadway Yellow Corporation, or YRC. Actually, if you go to the Google it or go to the stock market and enter this symbol, it gives you all the information about YRC, nationwide, worldwide. I even don't remember the name anymore, because I was not part of that. Roadway was part of Roadway. When they merged, I got out of there. So, Yellow Roadway Company Worldwide, that's the name of it. So what happens here is this is the point I'm trying to elaborate, is about the high rate of return on their stocks and equity, was that because of this merger, our stocks increased in the value because we were solid, extremely conservative company with no debt. So rate of return of our stock was like half of theirs. But now we merged. Guess what happened to us? Our stock jumped like 35 to 40% increase in value. And it was like, oh my God, yeah, look at my portfolio, my 401k. Jesus Christ, it's twice as much. Hey, that was the attitude at that time. Without side story that I'm not going to mention it here, but maybe later on, is that bottom line was, whoever stayed with their stocks over a year, 1 year after the merger, the price per share of stock dropped from $72. When I retired, it was $72. I retired with $72 with the house. Dropped from 72 to 46 next year, the following year 22, the following year 25 cents. From 72. Why? Because they could not meet the expected rate of return on the stocks. They couldn't.
So did it delist it at that point?
Mm-hmm.
Would it get delisted at that point? At that low rate? Would it get delisted?
Yeah, actually, like I said, when the price of your stocks get to be 25 cents, they kick you out of the stock market. We were part of NASDAQ. They kicked us out. And when I retired with $72, don't worry, with $72 per share, I was extremely happy that I'm going to be well off for the rest of my life. But when it dropped 25 cents and it was kicked out of market, guess what? Value of my portfolio was almost zero.
Right.
And you know what happens here? Yeah, you may hope it's going to come back again. Yeah, it did after a few years. But guess what? It's too late for you. Why? Because when it's on the 1 cent or it's penny stock, some investors buy like what, 5 billion of them. So, out of 5 billion, how many you got? How much it's worth? $25. Good. You see what I'm getting at? So it's basically you're destroyed.
Why didn't they do a reverse stock split to stay on the market? Do you know why?
They did what?
Why didn't they do a reverse stock split to stay on the market? Something like that happened.
Yeah, well, but they did the reverse. They did the reverse.
Oh,
Right
okay.
now, the price per share is $17.50 or somewhere around there. Okay? But what I'm saying is that it's already diluted, meaning that let's suppose if I have 10,000 shares, comparing to the number of the stocks out there, just because it was purchased when it was only 2 cents or 5 cents or 25 cents, and instead of having, like, say, 10 million stock out there, now we have 10 billion stocks out there. What's the worth of mine? Nothing.
Yeah.
So, that's the good, that's the extremely great example of what financial leverage could do to you. Yeah, your rate of return is wonderful. People, stockholders love you. But also the same stockholders could be upside down if the things changes a little bit, as it did. That change happened in the financial crisis of 2007. That was the time that the company could not meet the expected rate of return. For 1 year, it drops in value. Second year, drops more in value. And third year, basically, you're out of business. If you cannot meet the expected rate of return for 3 consecutive years, you're going to be out of business. They are in the business, but what's the worth of it? Meaning that all the people like me, they part of their 20 years of my life I spent in there, and I was in top management, middle to top management throughout my career. What did I get out of that? Nothing. For 20 years, zero. Well, it's not zero. It's like I talked to, I don't know, 5,000, 6,000, maybe 8,000.
That's where it was.
Yeah, because when I retired, like I told you guys, I said I'm set for life. So, what's that?
You should have probably sold all your.
I couldn't. Oh,
When
absolutely.
you retired.
No. See, this was the, first of all, when in the transition, they give you the choice,
Okay.
but you cannot withdraw it. They give the choice of whether you want to have it in this company or that company, especially if you are spinning off from other subsidiaries, like let's say General Motors is trying to spin off from Dodge and Chevrolet. Dodge and Chevrolet would go on their own way with a different name. GM goes on its own way. So they give you the what? Option. You want to go with that, you want to go with this. A merger, you don't have much of option because you can't do nothing about it. Now, after a merger, everything settles, you always have the option of liquidating your 401k. But if you're not up to the age of 59 and a half, not only you're going to pay the taxes on it, but also you're going to be penalized for another 10%. So I would have probably paid 40% of my 401k if I would have liquidated or took it out and did something else with it. That was silly. Why it was silly? Because it was not that I was not active. I talked to, many times I talked to these brokers, analysts in the Fidelity, and sat down hours and hours. We went over everything. What was their recommendation? Dan, look, man, for the last 40 years, they are more stable than gold. So yeah, well, the merger is going to give you this ups and downs, but it's going to come back. Why are you worried about it? I guess you're right. How right were they?
Crystal ball.
Yeah. So again, these are like unanticipated events. To people like us, not us. If we were expert in the market, we probably could have seen this. Meaning that based on the historical events of many companies, they say, okay, this company is highly leveraged, this company is joining that, yes, stocks are going to go skyrocketed, but after that it's going to climb. Then this is the trend. Some of us, we knew that. But the majority does that? They do know that? Absolutely not. They don't. So what happens is that they go with the recommendation of the experts. What expert says, don't worry, everything is hunky-dory. Yeah, you have dips, but you're going to come back and all these stuff. Again, why they say that? Basically, they're also saying based on the historical trend. So, I could have done anything different? Not really. If I would have taken out all my stocks and put it in different accounts, I would have paid like taxes, which is 28% plus 10% penalty. 38% of my 401k would have gone toward different direction. I didn't want that. That's silly. So, and I was not over 59 at the time. I was much younger than that. But I feel younger today. Anyways, yeah, that's about financial leverage, folks. It's a risk. It's a high risk. When you buy a stock that gives you extremely high rate of return, be happy, but also keep in mind that you may go down any day. Okay, that's that. Any questions on this one? I do have other stuff that about my own experience with those days, which I'll talk about it later on, but those are a few things that I would like to share with you. Okay, so finally, market value ratios, meaning how market sees you. So far, what we talked about was how you see yourself, how you analyze your ratios, turnover ratios, profitability ratios, so far, so on, within the parameters of your company. But does also market sees you in that way? We have to take a look at the what? Market value ratios. So number one is price earning ratio. Is it familiar to you, this price earning?
Yeah, the PE ratio.
Yeah,
because
PE
they're
ratio,
they're listed
yeah.
on your stocks whenever you buy one. Yeah.
Exactly. So PE ratio is an important one. That's how market evaluates you. And the PE ratio basically is your price of your stock divided by earning per share of your stock. So what is the meaning of it? Meaning of it is my PE ratio, let's say here, is 14 times, okay? What that 14 times means? First of all, PE ratio is about the times, meaning that how many times investors are willing to pay for $1 of earning per share of that stock. Meaning that if my earning per share is $1, investors are willing to pay me $14 for this stock. Follow? That's the meaning of it. Obviously, higher is better. Is this company's PE higher than market? Yes, it is. So obviously, the stock is performing better in the market. As I said in our previous discussions, PE also has a different function, and that is for companies that they are not publicly traded company, they are let's say privately held company. You don't know the price of your stock, right? Well, how much is it? There are methods to do that. Of course, we're going to learn about it, how you calculate intrinsic value of stock. But if you don't go that far, if you want to have a kind of shortcut, easier way of figuring out, you use PE ratio. Okay, how do I use that? Well, PE ratio says price divided by earning per share. I want to find the price of my stock. How can I use that? Oh, okay. Is there any company out there that is in close competition with you? Similar company? Yeah. Are they publicly traded? Yeah. Use their PE ratio. Oh, their PE ratio is 14 times. Okay, use that. Take that and multiply with your own net income of last year. That's known, right? Well, this was our net income. Let's say that's $1 million. Multiply 14 with 1 million, worth of your company becomes 14 million. That's how you calculate worth of your company. Now, I want to know the price of my stock. Okay, deduct from it your debt and preferred stocks if you have it. Then your value of your total company would be in terms of what? Stocks. How many stocks you got out there? Well, have you got 10,000 of them? Okay. 14 million divided by 10,000, that'll be the price of your stock. Follow? That's how companies use PE ratio as well. But PE ratio mostly is for the stock market and the people, potential investors, that they want to know what is their price earning ratio, and obviously they're going to go with highest PE or better profitability. Okay. Here is PE ratio for this company is 9%. Yeah, these are examples. Okay, the other ratio that we use for market valuation is called market to book ratio. Market to book ratio is that market price per share of your stocks divided by book value per share. Okay, and that gives you again a figure, let's say in this case is 3.16 times. Now, let me explain a couple of things. First of all, you know what the market price of your share is, right? What is it traded for today, right? What is the book value of your share?
Exactly.
Where do you find that?
So,
And what is it? Anyone? You should know. the day that this stock was issued, how much was the price of it? Period. Oh, 5 years ago, this stock issued at $15. How much is it now? $32. Oh, so how much this stocks of this or price of this stock has grown? 3.16 times, 3 times as much. That's what the market to book means. Make sense? So obviously, higher the number is, means that your growth of your stock has been better than the average of the market. The stocks of this company obviously perform better than the average of the market. And average of the market is what? And this is peer group, that's fine, but also you could compare it to average of the market. What is average of the market? Where do I get that? Again, I'm going to repeat some of these many times till we become comfortable with it. Where do I get the average of the market when I'm comparing my stocks to average of the market? Where do I get the average of the market?
Fidelity's website. I said Fidelity's website.
That's cheating. No, I'm just teasing you. Folks, I talked about it. I normally ask you the question whether I'm assuming that you should know or I already discussed it in the past. Didn't we talk about Dow Jones Industrial Average? Didn't we talk about S&P 500? Yeah, that's the average of the market, folks. You always compare it to the market index. Okay, which of these you belong to? Do you belong to NASDAQ? Do you belong to S&P 500? Do you belong to Dow Jones Average? Whichever you belong to, you look at the index of that particular day. And you're going to see whether the market in general is declining or increasing and where you are in the range of those changes. Above it, below it. So that's how you compare the performance of stock in average of the market. However, this is not as important as when you've compared the price of your stock in your own industry. That's more telling. Mean that, yeah, in average of the market, total all the stocks, you're doing 0.5 point better. Okay, good. How are you doing on your own industry? Because your own industry might be extremely higher than the average of the market itself. So that's peer group. That's what we have it down here. So in their industry, peer group was 2.7 times growth of the stock from the day that it was issued. This company had 3.16 times the value from the day it was issued, which was $10.13. Now it's $32. Again, how important is this? This is important because of the investors, not because of you yourself and how you value the company. Your valuation of your company is based on all the ratios that we talked about. Those are what you're going to be focusing on. However, how the market sees you, because like I said, in the market, imprecise perceptions and judgments rules rather than the precise calculations. Meaning that if your stock is in demand for whatever reason, you're going to increase in value. If it's not, for whatever reason, it's going to decline. What are those reasons? Some silly reasons, stupid reasons. Yes?
So the book value per share, are we going to get it by dividing the common shareholders' equity divided by common shareholders?
Number of the outstanding shares, right? At the time of issuance.
And also I have a question from the previous slide.
Hmm?
Previous slide. I have a question from the previous slide.
Previous slide, yes. Okay, let's go to previous slide.
So you said we'll be taking the P ratio of the our competitor. So why?
Okay, say it one more time.
You said we will be taking the PE ratio of a competitor.
Yes,
calculate.
yes,
So
yes.
why competitor and not our own company?
How come we don't have to, ask the question one more time, I'm
So
sorry.
why would we be taking the PE ratio of our competitors?
Because we don't have it ourselves. We don't have it, but what are we trying to find here? The price of our stocks.
Okay.
So here it says price of your stock divided by earnings per share. I don't have price of my stock. If I had it, I didn't need.
Okay, so we would be keeping the competitors as.
Right, and why we do that, remember what I said, if your stock is publicly traded, you know the price of it, market price of it at least.
Okay.
But if it's not publicly traded, you don't know what the value of your stock is. So you're gonna be using your competition's PE, multiplied with your own net income, you come up with the value of your company. When you come up with the value of your company, you're gonna deduct the debt and the preferred stock from it. It's gonna be value of your company in terms of the stocks. So divided by number of the stocks, that's the price.
Okay, I got it. Thank you.
You're welcome. Okay, we're almost there, folks. Anything else? Okay. Here is again comparison of Apple and Dell net income. You see how different they are. The reason for it is also given here. You could see it. Net income, of course, I think is in terms of millions. So 8 billion something, 1 billion something for Dell. Shares outstanding, how many shares they have. You see that Apple has less shares than the Dell. And earnings per share, Apple's is way up there compared to Dell. Price per share, obviously you could imagine with the number of the share being less than Dell and also having more income than Dell, the price of the stock is way above Dell, $241 versus $15. And book value of the compounded common stock is $5 million for Dell, $31 million. It is 31 billion, I'm sorry, for both of them. And book value per share, $2.88 versus $34.88 for Apple. Obviously, again, these ratios is not giving you the answers. It's just giving you the ideas to go and do research to see why, for instance, the price of Apple is way above Dell. Well, some of those you see it because of the net income and the number of the shares they have. But some of them you could do more investigation as to why even the price is that high. So anyways, those are some of the things. Yeah, again, at Dell's and Apple's price earning ratio and market to book ratio, you see Apple again is doing much better. I think that's it. Okay, this is your assignment in the class activities. This figure is a realistic figure from Gap Inc. Somebody says, okay, you have taken finance course, you know finance. These are all the ratios for Gap in comparison to the what? Average of the market. First of all, decide whether they're doing good or not too good and what possibly could be the reason. Also give us the interpretation of why, let me see what was that. Okay, well, what I'm saying, current ratio, that's fine. Okay, so give us interpretation as to what profitability? Where is it? Profitability, profit margin. Okay, They have net profit margin, operating profit margin, return on equity. Okay, here we go. Okay, return on equity. You see that 21.36 versus the average of the market is low, right? They are not up to bar, up to the standard. But yet in the meantime, you look at their net profit margin is way above that. What's going on here? I want you to pay attention to this, compare to the average market, and then come up with the answer as to why their return on equity is lower while they are more profitable and they have many areas that are above the average on market, like gross margin, except for that book to market to book. Okay, take a few minutes, take a look at it, and come up with the answer as to why they have return on equity that is less than the average of the market. And why we emphasize on the return on equity? Because it captures everything about the company, right? We talked about it. So, why their return on equity is lower than average of the market, where other areas they are basically performing better than average of the market? What's the answer to that?
They have low leverage.
Exactly. Take a look at that. In average, this industry buys their asset with 17% debt. I mean, on average, these companies in this industry, they have 17% of their total capital is by debt. They borrowed money. Look at that, 1.39. Basically, they don't have any debt. It's like, this is my company, right there. So, therefore, return on equity is going to be low. Because remember what I said, one of the reasons for return on equity being high is what? Financial leverage, the level of debt. So the level of debt is lower for GAAP, therefore the return on equity is low. But is that bad?
Depends. Well, it drives down the stock price.
Yeah, but if I'm going to buy the GAAP, do I say, oh, this is a low rate of return, I'm not going to buy it, or I say that it's okay? Most likely I say, okay, you know why? Yeah, low return on equity, what is it? Low return, but also what? Low risk. So it's a good stock, it's a stable stock. Doesn't have much risk associated with it. It's a solid conservative stock. If I want to balance my portfolio, which is wild portfolio, I better buy GAP's stock and put it in my portfolio because it's very solid. It's not much of risk associated with it. Yeah, also the rate of return of it lower than the average of the market. That's how we make interpretation. You see, even the profitability is great. Everything, or some of the things are very similar to the market, not much difference. But all those things, you see that, and this is the reason right there. Okay, we're done with this. One more thing I would like to share with you. That much time. Okay. This is from your own textbook. The difference between EVA and MVA. Market value added and economic value added. I would like to share with you, because this is going to be part of our discussions and reading materials in the future, so I would like to give a certain definition to these. Folks, market value added is a market value of your stocks. Basically what you do is take the price of your stock in the market, multiply the number of the shares you have outstanding. Let's say the price of your stock is $10, number of the shares that you have in the market is 1 million, so that's 10 million. Then deduct it from the book value of these shares, meaning that at the time they were issued, what was the price of it, and number of it. So the difference between book value and market value of your stock is called market value added. Now, what's the benefit of it? Benefit of it is that to give you a glimpse of what is the market value of this particular company. Let me give you an example. Remember, I said this in the past, and I'm going to repeat that more in the future, that when you want to invest, there are certain criteria that you follow. There are 4 steps, that is universal steps you follow, and each one has its own significance. We're going to talk about, actually, we're going to talk about this next week. We're going to talk about present value and net present value and future value, so forth, so on. And next week, we're going to start, our calculations, by the way. Make sure that you don't forget your calculator. So we're going to do some exercise in the class from starting next week. Now, if we're assuming that for any investment we have to do a lot of calculation, especially more complex calculation for companies, meaning that if you're interested by a company, what type of calculation you do, what kind of analysis you do. Somebody may ask this simple question. Hey, wait a second, Dan, why are you going through all this trouble? Buy the 100% of stocks of this company, you own them. What are you calculations for, right? Hey, how many stocks they have? They have 10 million stocks. How much is it per share? It's $20. So 200 million. Jesus Christ, you own the company. So what are you doing here? What calculation? You with me on that? Well, why we don't want to do that? Why we go through the trouble of using a lot of models, formulas, in different methods, as a matter of fact, of analyzing the company and coming up with the true value of it. Why are we not dependent on that market value added? Why? If somebody says, hey, IBM, let's buy the IBM. How much is worth? Jesus Christ, well, just take a look at the number of the stock they have in the market, multiply with the price of it. That's the worth of the company. But the answer is, no, you don't want to do that. Why not? Answer is very simple, and we talked about it.
It is the current value.
What's that?
It's the current value. We don't know how it will change.
Is it kind of like the market price versus the intrinsic value?
Exactly, folks. This is market price for it. Meaning that how much your stocks is traded for. Based on what? Based on speculation, based on supply and demand. Is this company overvalued or undervalued? We don't know that. Then you have to do other calculation. Because easily, especially if you're talking about your companies, major companies, that you're spending billions of dollars, if it's overvalued, you're going to lose billions of dollars. You follow? It's not like the difference of $500. It's a major difference if it's overvalued. Company that has 100 million stocks outstanding and the price is overvalued with $32, where the true price of it is $20, you're paying what? $12 over 100 million stocks. That's how much you lost. So it's important for us, imperative, that we come up with our own calculation. And there are wonderful methods that we're going to learn in this class, how you do that. So that goes to show you the market value of stocks of any company, or even the value of any company. It's only a market value. We just want to know how other people see this, how investors see this company. That doesn't mean it's the true value of it. So, market value added is the difference between the book value of all these stocks with what? Current value of all these stocks. And it only serves that purpose, nothing beyond that. Oh, okay, this company, comparing to their book value, they have like what? Increase of this times, let's say 2 times, 3 times as their book value. No. But then again, you don't know it's overvalued, undervalued, is it the real price of it? No, none of it's real. These are all, again, based on supply and demand. However, the second one is more important, more accurate, meaning that when you do MVA, you have to do EVA to ensure that you are coming up with the true value of the company. That does not, by the way, EVA does not give you the true value of the company, but gives you a better idea. What is the better idea? If you take your EBIT, which is your operating profit, right? Adjust it to taxes, well, minus T, and deduct it from investor supplied capital. What is investor supplied capital? How much people paid money to buy your stock. That's it. How much they paid money, total money, to buy your stocks. Oh, we collected $100 million by selling our stock. Okay, take that, multiply that with the cost of capital. What is the cost of capital? Remember, I touched on it, but we're going to spend a week for it, talk about it. Meaning that how much the company that used this capital to buy their asset, the capital cost this company. What do I mean by that? Let's suppose capital of a company is all borrowed money, okay? 100% of it, which is unlikely, but let's suppose. What's the cost of capital of this company?
Interest rate.
Exactly. That's it. Hey, bank is charging us 8%. Well, that's your cost of capital. Why this is important? Why we should know that before anything else?
Why should we know the interest rate?
Yeah. Why we have to know definitely cost of capital? No, I just say this is one example, but why we have to know our cost of capital all the time?
How much they're gonna have to pay?
Okay, but more importantly, what?
It affects profitability.
What do they
We
need?
cannot invest this money in any investment that gives us less than our cost of capital. Oh, this is cost you $8, but you're invested in it, it yields you $7. You're silly. You follow? That determines your criteria as to what investments are acceptable, why some of the investments are not acceptable. So if I'm paying 12% as cost of capital, and basically reality is right around there. Why? Because debt is cheap. 8% is cheap, 6% is cheap. And tax adjusted, why is tax adjusted? Debt is tax adjusted. Why debt is tax adjusted all the time? Because interest that you paid on it is what? Tax deductible. So when you borrow money with 8%, actually you paid 5.5%. That's how you adjust it. How do you adjust it? Multiply with, right there, parentheses, 1 minus T. What is T? Tax rate. If that is 40%, that'll be EBIT times 60%. Make sense? So that's how big difference is. Therefore, when you borrow money, always you have low cost of capital. Then why in the world I'm not doing that for all the companies? Let's say why 100% of the companies borrowing 100% of the money to have the lowest cost of capital? What's the answer to that? Hey, if we decided that borrowed money always has lower cost and it's also tax adjusted, why in the world I want to issue stocks that I'm paying 12% on it?
Debt is high risk.
What's that?
The debt is high risk.
Yeah, but how, maybe I should, well, that's true. However, if I'm a company, I want to take that risk, meaning that what? Jesus, I'm going to pay 5.5% tax, 8% tax adjusted would be 500% on borrowed money versus if I issue bond, it's going to be 10%. If I issue stocks, it's going to be 12.5%. Okay, I want to go with the debt. You may do that, not necessarily that's a good choice. What I'm saying is that why companies even they don't even have a desire to go that direction. Because folks, there are two reasons. Number one is what Charles said is you're basically embracing a higher level of risk. But number two, the most importantly, is that no bank is gonna finance you 100%. Banks are not idiots sitting there, yeah, here's 500%, go, I'll see you after 30 years. No. No bank would take a chance. Yeah, they make a chance with you and I, give loan or something like 500,000, buy our house, we risk it, they don't care. But when they want to loan $5 billion to a company, they cannot take the same measures. Therefore, the slightest percentage here is extremely sensitive for their calculation. So my point is that banks would not finance anybody 100%. However, is that really what it is? They never ever know. They would do it if you insist. But you know what they're going to ask you? Okay, if the percentage of your debt, 20%, we're going to give you 8% interest. If it's 80%, it's going to be 14.5%. You with me on that? So you're going to say, shoot, if I borrow money, it's going to be more expensive than what? Cost of my equity. So that's why banks increase their interest rate? Because they know you're going to be extremely risky. You may go upside down any day, and you want to take a risk. Yeah, okay, you insist, we'll give you 80% of what you need. That's 14.5. That's why people do not go 100% on finance or go on financial leverage and increasing it to drastic level. They don't want it. But there's also one factor here that you never forget. If I'm a company that, let's say, 50% of my capital is raised by equity, by stocks, and 50% by debt, now I'm increasing my debt from 50% to 70%, or I'm going to buy my stocks back and do that. But not only I'm going to pay higher rate of return or higher interest rate on my debt, but something else is going to happen. What is that? Your stockholders are going to demand higher rate of return. I was paying 12% to my stockholders. Now they're demanding 14.5% because of my debt. That's how it is. We're going to talk about, you're going to do some example problems on this in our WACC discussions. Okay, but for now, I want you to pay attention to this because EVA is very, very commonly used measure in the market to estimate the value of not only the company, it's also value of the stocks. So basically, your net operating income minus total money that stockholders gave you in exchange of their stocks, multiplied by cost of capital. What is cost of capital? Let's say if you borrowed money 100%, that's your interest rate. If you have the combination of stocks, bonds, and borrowed money, then you're going to be calculating this, and we're going to talk about how to calculate this. Could be your stocks is cost of equity is 14.5. Let's say you have also preferred the stock with 10%, and also your bonds are having 10%, but also you borrowed money with 5.5%. Okay, what are you going to do? You're going to create a composite weighted average cost of capital, WACC, which basically is the percentage of each one of them multiplied by cost of it, add them all together, that's cost of your capital. And then when you say, oh, 11% is cost of my capital, that is going to give you a lot of abilities. Number one, you're going to know which investment you should not make. Oh, this investment pays me 10.5%. Jesus Christ, you're paying 11% to get 10.5%? That's not very smart. Number two, which is the most important part of it, which you're going to be involved in it in our future discussions, and you're going to do some examples. You're going to use this 11% cost of capital as your discount rate to discount all your future cash flow to present. This is what I'm going to be talking about next week. And let me give you an example of what I'm talking about. If somebody said, hey, price of this particular company is 100 million. Okay. Is it a good investment? Yeah, well, let's take a look at it. How much this company is going to provide us? Well, let's suppose this is a, I don't know, high-rise building, and after 30 years it's going to be demolished. Okay, so for 30 years, how much I'm going to have cash inflow, meaning that I'm going to get cash flow out of this building? Oh, you're going to get $10 million every year. Okay. For the next 30 years, I'm going to do that? Yeah. Is this a good investment? For the next 30 years, you're going to get 10 million every year, and the price they're asking is 100 million. Is that a good investment? It looks to be a good investment, right? You're going to collect what? 300 million, billion, or million, right? But that's not how you calculate this. Because you're, what, 10 million 30 years from now is worth only a couple of million today. You follow what I'm getting at? So you have to discount it back and add them all together and then compare it to this 100 million. We're going to learn that next week, and we're going to learn also, I'm going to spend another week about the NPV and all this stuff. We're going to calculate those, and you're going to understand how important discount rate is for you. And what is the present value of your future income? It's much, much less than what you think it is. 10 million 30 years from now is maybe 2 million right now. That's how you're going to calculate. We're going to do all these future discussion classes. But at this time, I just want to give you some idea what MVA and EVA is all about. I'm basically done. I don't want to overwhelm you. I think we talked about a lot of good stuff, huh? But again, starting next week, my discussions, my lectures are going to be much less. We're going to do some stuff in the class. You're going to be more participant, and we're going to learn by doing it, not just talking about it. Okay? But this first week and second week is just introductory, to introduce you some of the concepts on finance. What are the ratios? What are the stock market? And how some of these operate, in general ideas that we get in here. Also bear in mind, I'm going to use this technical words in finance and repeat it so many times. You're going to say, hey, we got it. Because if you walk out of here after 10 weeks and you don't know what equity means in finance, shame on me. All right? Any questions or comments? Have a wonderful night. If you have any questions, don't hesitate emailing me. I'm normally good at returning your emails.
Have a good holiday. Thank you.
Oh, yeah, great. Have a wonderful 4th of July. Stay out of trouble. And I'm expecting